This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss how the current market and economic environment affects retirees and give perspective on the 2.5% cost of living adjustment to Social Security for 2025. Those either planning for or already in retirement are facing challenges due to recent economic conditions, including high inflation and market volatility, leading to concerns about whether their savings will last. Despite the recent stock market recovery and higher bond yields, uncertainties remain around the presidential election, Fed rate cuts, market valuations, and much more. Building a flexible financial plan with proper guidance remains the best approach to minimizing retirement risks and maintaining quality of life. Over the next few minutes, we'll discuss a few key facts about saving and planning for a long, fulfilling retirement. First, this chart shows annual cost of living adjustments to Social Security benefits over time alongside the inflation measure it's derived from, which is the Consumer Price Index for urban wage earners and clerical workers. As you can see, the 2.5% cost of living adjustment that was recently announced for 2025 is lower than in recent years. This reflects a deceleration in inflation since 2022, but may not adequately address rising costs in the areas like housing and healthcare. To put this in perspective, 2022 saw an 8.7% adjustment, the highest since 1981. While these adjustments are helpful, they may not be enough for many households. This underscores the importance of maintaining a robust investment portfolio to support a steady quality of life, particularly given the increasing life expectancies and challenges posed by inflation. Next, a popular rule of thumb for retirement portfolio withdrawals is known as the 4% rule. This rule tried to determine a quote-unquote safe annual rate of return to avoid exhausting savings over a 30-year retirement period. As you can see in this chart, this is based on historical data that shows the worst withdrawal rate would have been 4% historically based on certain assumptions. It also shows that the inflation-adjusted maximum safe withdrawal rate for a 60-40 stock bond portfolio has varied fairly dramatically over many decades. This should not be a surprise since market returns have also varied significantly over this period. Despite recent market challenges, the current safe withdrawal rates remain strong, emphasizing the importance of maintaining an appropriate multidimensional asset allocation, incorporating diversification of not just asset classes, but also diversification of strategy and approaches, striving for multiple layers of non-correlation. Finally, this chart shows average life expectancies for men and women, which have risen dramatically over the past half century. With more people living into their 90s, while this is a fantastic development, it also represents challenges for retirement planning. Longevity risk, or the possibility of outliving one's financial resources, is an asymmetric risk that makes it very important for retirees to have both portfolios that can generate both income and growth to maintain their quality of life over potentially decades-long retirements, especially as inflation remains a concern. This means that even during retirement, it may not be enough to only own bonds or income-generating assets, since portfolio growth is still needed. Thus, it is always important to hold an appropriate portfolio, ideally with the guidance of a trusted advisor. We hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our eye-opening white paper titled Busting 7 Risk and Return Myths. You can click the link below or visit our website at dynamicwg.com or email us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, Take care, everyone, and make smart, logical, and fact based financial decisions.